Let's start with the incredible divergence. As of today, November 27, 2025, the Pi coin price is hovering around 25.8 cents. It has been a short-term titan, adding 2.5% in the last 24 hours and over 11% in the last 30 days, while the majors were in freefall. This relative strength is what draws everyone in, but it's also what hides the trap. That trap is a textbook head and shoulders pattern. For those new to chart analysis, this pattern is a classic bearish reversal signal, typically marking the end of an uptrend or a relief rally before the next leg down. It's formed by three peaks: a left shoulder, a higher central peak, the head, and a lower right shoulder. The crucial element is the neckline, which connects the lows between these peaks. In Pi coin's case, that neckline sits precariously close to the 21-cent level. If the price decisively closes a daily candle below that 21-cent zone, the pattern is confirmed, and here is the mathematically derived downside target. The distance from the head to the neckline projects a brutal 34% decline. That move would drag the Pi coin price down toward the 19-cent area, or even lower if the broader crypto market decides to capitulate. The simple reality is this. The chart is structured such that if the momentum slows, the downside risk is massive and immediate. Now, let's add momentum to the equation, because it reinforces the structural warning. We have a clear signal of weakness known as Hidden Bearish Divergence on the Relative Strength Index, or RSI. The RSI is a metric that tracks the speed and change of price movements. It measures buying and selling pressure. Between November 20th and November 26th, two key things happened. Pi coin formed a lower high. This is the right shoulder of the head and shoulders pattern, a technical sign that buyers are losing steam and cannot push the price back to the previous peak. Simultaneously, the RSI itself made a higher high. This decoupling is a hidden bearish divergence. Why is it dangerous? Because hidden divergence usually signals the continuation of the prevailing trend. And despite the short-term 11% surge, Pi coin's dominant 30-day trend before this bounce was overwhelmingly weak. What this means in plain language is, the current up move is real, but the smart money isn't backing it with conviction. The underlying selling pressure is still there. And any pause, any slight consolidation, could flip the momentum back to the downside quickly, using that head and shoulder structure as a catalyst. This is the definition of a technical house of cards. You now know the risks, but understanding the reversal levels is how you stay ahead. I'm about to show you the precise price target that invalidates this entire bearish structure. Before we get to that critical level, if this technical breakdown is providing you with clarity that you won't find on social media, take 2 seconds and smash that like button to support the channel. And if you're serious about navigating these volatile markets, hit subscribe to TJ Crypto World and turn on notifications. You need to catch these warnings in real time. So, what is Pi coin's escape hatch? How does it save itself from that 34% drop? It's simple, but, it requires absolute conviction from the bulls. Pi coin must achieve a daily close above 29 cents. This 29-cent level represents the top of the head formation, and breaking it would entirely invalidate the head and shoulders setup. A confirmed close above 29 cents would signal a genuine shift in market control, allowing Pi coin to target higher resistance zones and continue the aggressive uptrend. Until that happens, every dip requires immediate attention. Let's mark the immediate battlegrounds, with the price currently near 25.8 cents. First support, or the immediate check, is 23 cents. A temporary consolidation here is normal. Losing this support, however, signals immediate technical weakness and brings the major danger zone into focus. Alright, so let's talk about the breakdown zone, sometimes called the death line. This is that 20 to 22 cent zone, and it's super important because it contains the critical 21 cent neckline. Now, if we get a daily close below this 20 to 22 cent area, that's when the 34% downside trigger gets pulled. If that happens, you're probably looking at a move toward 19 cents, maybe even lower, especially if global market conditions, like say, a sudden dip in Bitcoin, add more bearish pressure. The whole technical story for Pi coin really comes down to one harsh reality. It simply cannot afford to hit the brakes. The current uptrend only survives as long as it keeps climbing and clearing that 29-cent resistance. A pause here isn't really consolidation. Honestly, a pause is just an opening for the bears to step in and confirm a reversal pattern. So, to sum up the core message here, for bullish confirmation, you want to see a daily close above 29 cents. That's what invalidates the bearish pattern and keeps the uptrend alive. On the flip side, a daily close below that 20 to 22 cent zone is what triggers that projected 34% decline. Pi coin is right now fighting serious technical gravity. we've seen some pretty wild volume spikes lately, mostly thanks to news about new gaming partnerships and all this talk about MyCA compliance. But, fundamentals only win out over technicals if the buying pressure actually sticks around. This is a high-stakes moment for the asset, no doubt about it. Your job isn't to predict the future, it's to respect these levels. Thanks so much for watching, seriously. I really appreciate every single one of you in the TJ Crypto World community. If this breakdown helped clarify the Pi coin price action for you, I'd love it if you could show some appreciation by giving the video a final like. We've got a deep dive coming up next on the CIDI Games partnership and whether that utility can actually save Pi coin from this technical trap. Trust me, you need to see that one. Until then, stay vigilant, manage your risk, and I'll see you in the next analysis. This is TJ, signing off. Let's make smart moves.